Hello and welcome to the Commercial Real Estate Talk podcast. This is episode 130, CRE Crisis. CRE Crisis, obviously CRE stands for Commercial Real Estate Crisis. And we're not trying to use hyperbole here. This is what's been dominating the news here in the last week, and whether it's Deutsche Bank, whether it's Blackstone, whether it's Harvard Business, a lot of flags are going up saying, folks, we're not out of this yet. I believe a lot of people in the commercial real estate industry thought by now we would have seen a couple of rate cuts. That hasn't happened. We might have seen the economy stabilize. That really hasn't happened. In fact, we're not even going to talk about it or look at it in one of these articles, but there has been an uptick in unemployment, and one of the articles shared that we're all focusing on June and July because if there's a slight uptick, I mean, from 4.1 to 4.2% when it comes to unemployment rate will trigger signs that we are perhaps in a recession, which is, all what breaks loose if you start floating that word recession out. So nobody wants to use that word, but that's what's happening. Let's get right into our articles so that we can value your time. And listen, the first one we're going to look at is from Harvard Business Review. Harvard Business Review says U.S. commercial real estate is headed toward crisis. Okay, so we didn't make this up. It's not hyperbole. Episode 130, CRE is in crisis, from Harvard Business Review. This is a very, very lengthy article, so we can't possibly read it all verbatim. I'm going to try to give you some of the highlights. And this is a reminder, if you haven't already, join us on LinkedIn. Find a way to connect with us because we pump all these articles through LinkedIn, through the Blue Box Real Estate corporate page, okay, through our commercial real estate firm, headquartered in South Florida. If you follow us there, then you will see all these articles come through. All right, let's get into this. U.S. banks face a reckoning. Over the next 2 years, more than $1 trillion in commercial real estate loans will come due, according to the Conference Board calculations using MSCI real asset data. Institutions with most concentrated exposure, insufficient capital cushions, and limited lifelines from large institutions and regulators face significant losses. Yeah, you think? The damage could, this is the key, metastasize into a full-blown financial crisis if scores or even hundreds of small, mid-sized commercial banks fail simultaneously. A worst-case scenario might include contagion to other economies, banking deserts across the U.S. I mean, look at this language, folks. Metastasize, contagion. I mean, this person has a little bit of a medical backdrop, I see. All right, now how did we get here? As the Federal Reserve rates keeps interest rates elevated and CRE, commercial real estate risk, worsen with falling property values, businesses will continue to experience restrictive financial conditions. Executives can nonetheless take steps to potentially mitigate the fallout, including examining banking relationships, extending debt maturities, and securing adequate working capital. How do we get here? I think it's important. This is so important. We talked about this last week, didn't we? If you want a little drink from a fire hose of rent caps and why it's a bad idea for commercial real estate and the economy, go back and listen to episode 129, and we discussed Biden's confusing announcement on rent caps. And look, a week later, he's no longer running for president. So things are just coming at us so quickly. But how did we get here? We talked about it's important not just to say, hey, we have a problem and let's put a Band-Aid on it. We have to diagnose how we got the problem. If you have a pain in your body somewhere, yeah, you can rub a little medicine on it and think it's okay, especially if it's numbing medicine. But you need to figure out how did we get here in order to diagnose whether there's something more serious going on. And listen, these folks started this conversation by saying metastasize and contagion. I mean, these are medical terms. You've got to figure out what's going on if you have an issue. So what's wrong with the economy? How did we get here? Why is it that CRE loans are in trouble and potentially can drag down the entire commercial real estate sector with it? The risk of U.S. commercial banks being overexposed to CRE have intensified as a global pandemic upended long-held economic assumptions. Perpetually subdued inflation, out the door. We've had inflation ad nauseum. Low interest rates, out the door. We had a 10-year cycle of almost 0%. Now we're back to really more standard rates, but the economy is freaking out. And in-office work, that was a given. If you had a job, you went to the office or to the warehouse or to the retail store or wherever you went. You actually got out of your place, showered, put on some clothes, and you went to work. That's all been upended after the pandemic. So all these things are coming together. Exasperating situation are CRE management costs, including insurance premiums, labor and energy prices, which have skyrocketed. It's another word for inflation. Cost of controlling and owning real estate has skyrocketed. Now, to point you back to Biden's cap rate, see, if you can't cap the potential profits or income without capping all the expenses. It doesn't work. And this is what they're saying. This is what we're seeing. Insurance has gone through the roof. Utility costs has gone through the roof. Labor, energy prices, these things keep going up. And that's a problem because you mix that with inflation, low interest rates, and in-office work. These things have been upended, and it's all coming down on the commercial real estate sector. An aging U.S. population, fueling labor shortages, forcing higher wages as firms to attract and retain talent. We could have easily discussed the great resignation coming. There was a great resignation after COVID where people said, I'm not going back to work. I'm going to file unemployment. And, hey, I can do this for months, if not a year, thanks to the government allowing me just to kind of take a little break on the backs of taxpayers. Well, that may happen again because folks are being pinched. They're asked to come back to the office, and they feel like their labor wages haven't gone up significantly, keeping up with inflation. So even if you're getting your standard 3 or 4 or 5% increase, it's not keeping up with inflation, the cost of buying food, housing, gas. So this is a big problem. And some folks are saying, you know what, I'm just going to take a break. I'm going to resign and square this away. So we're potentially looking at another great resignation coming up. And that's going to be a problem. That's going to be a problem, retaining talent. All right, natural disasters, property insurance, dated electricity grids, uneven energy transition, yada, yada, yada. That's how we get here. Now, there's trouble brewing. Next section kind of talks about the risk here. Hundreds of banks hold an outsized amount of CRE loans on their books relative to capital. Small banks, meaning they have $100 million in assets to $1 billion in assets, and mid-sized banks up to $10 billion in assets have CRE loan values far exceeding risk-based capital levels at 158% and 228% respectively. According to the Conference Board calculations using FDIC institutional financial reports data, you could look up any bank. The FDIC call reports are all public. So if you need help doing that, send us a note, PM us here, leave a comment, but we can help you do that and see the health of your bank. This is compared to 142% for large banks and 56% for the largest banks. So the smallest banks are the ones that are in the biggest trouble, right? CRE property values continue to fall. And so the article points out that debt service on associated loans accumulate, borrowers are becoming delinquent or defaulting. Now, why is that? Let's say you bought a building for $100 million in 2019, okay? And you did a 30% to 70% equity loan. So you got $70 million of debt, you put 30% equity, right? You've got to maintain those ratios. Now, what happens? The pandemic hits, the economy freezes, folks start working from home, and now we're 4 years removed from the pandemic, and you've had in 4 years, about 50 to 60% of your tenants have rolled over their leases. And as tenants' leases have been rolling over, office tenants are saying, you know what? We're paying for 10,000 feet, but we still have half our people working from home. I only need 5,000 feet. So either they relocate. Let's just say it's the worst case scenario. You're in an older B building. They relocate to a higher grade building because they're going to keep paying the same amount of money, but lower their square footage and have a higher office or a nicer office. So now you've got vacancy that's piling up, both from people leaving or downsizing. What happens? Remember, commercial real estate is based primarily on the income stream, the net operating income. This will probably be one of the teaching series that we do, so hang in there, God willing. So now you've got a building that was, say, 90% leased in 2019, worth $100 million. Now it's 75% leased, and because of the lower occupancy, the building is no longer worth $100 million. Based on the NOI and the cap value of that building, it's now worth $75 million. Problem. You have a $70 million loan on a $75 million building. So what's going to happen? They're going to fall into default. They're in default based on the loan to value ratio, and they're going to get slapped with the default. And now the owner has a decision to make. 70% of $70 million is closer to $50 million, 49, 48, somewhere around there. So that means the lender wants to pull back and ask you to pay down the debt, give us another $20 million in equity to bring the loan-to-value ratio back. Well, does the landlord really want to do that? They already have $50 million in equity or $30 million in equity on this building when they bought it. Now you're asking for another $20 million on a sinking ship, and this is the dilemma that's happening. And so some landlords are just given the keys. So, okay, fine, bank, it's your problem now. You take this problem, we'll eat our monies. And so that's what's happening now. Banks are doing workouts, blend and extend, or some of the articles will point out pretend and extend, because they're just kicking the can down the road. And there doesn't seem to be any magic potion down the road that's going to help this. But I hope that explains just a little bit of what's happening. This is what happened in the Great Recession. I was part of this. I was part of a large project of Brickell that went through this. And they did blend and extend and pretend, and the market in 2 or 3 years recovered, and we were able to get out of it. Let's keep going. What could trigger a CRE crisis? Okay, since this is our theme. Multiple troubled banks simultaneously raising equity capital would prove challenging and potentially destabilizing for the U.S. banking system. Remember, we operate all on, our country is a country of credit, right? Everything operates off the banking system. You can have a small business, you can have a large commercial real estate company. They all are tied to the banking system. That's where we are, folks. So a destabilized banking system means trouble for the entire U.S. economy. A hint of doing so could cause massive depositor flight, i.e. bank runs, creating a redux of the March 2023 panic across global financial markets when only 3 U.S. banks came under pressure. Digital banking has accelerated the speed at which these runs might occur. The clock is ticking for banks, delaying recognition of CRE loan losses and the time of the financial market fallout, potentially starting later this year. Everything's happening later this year. We have an election. We have potentially a financial crisis pending in commercial real estate and banking later this year. The conference board expects that the U.S. real GDP growth may be weaker and the unemployment rate slightly higher and interest rates still near multi-decade peaks, with cascade of banks reporting losses. Again, interest rates are high, expenses are high, occupancy is lowering, right? And rates are going to start to come down, and values of these commercial real estate buildings are coming down, and it's just a potential for a huge financial market upheaval and financial crisis looming. This article points to January of 2025 debt ceiling. These could include a U.S. recession that could trigger a crisis, interest rates stay higher longer than expected, and so forth. The potential fallout. This is why I like this article. Why we're going to spend most of our time on this article is because they really took their time. I think Harvard Business Review did a good job analyzing everything and kind of letting you know where the rubber meets the road here. As these loan losses begin to mount, an increasing number of banks, mostly regional and community, risk having insufficient capital cushions. 10% loss in CRE loans will leave more than 100, mostly small and mid-sized banks, representing $700 billion in assets, undercapitalized. 20% loss, 900 banks will be undercapitalized. All right, so Fed's officials have indicated that CRE crisis will probably lead to bank failures. We did see that in the Great Recession, right? Too big to fail. I just noticed my green screen. Let's see if I can fix that. Going the wrong way. There. Maybe there. All right. Well, I guess that's as good as it's going to get. All right. So, pandemic accelerated troubles in CRE market may take more than a decade to resolve. Aren't you? Aren't you glad to hear that? Increasing office space vacancies linked to remote and hybrid work could extend price declines and deepen losses for lenders in this space. Most empty or underutilized office space is too costly to convert to residential or other uses and will require deeper price concessions. Who's going to get stuck with the hot potato of that office building? You have a 50-year-old building built in the 80s or 70. You're highly leveraged on this building. You bought it at the top of the market. It's not like your basis is low that you can say, yeah, let's just scratch all these leases, and which creates another problem because you can't do that. You just can't terminate leases to convert the building to residential. But let's say you could. Your capital costs are tremendous. Your holding costs on that office building could be $300 a square foot, plus the cost to convert it. The market's not there. It's not going to justify. And then from a residential perspective, who wants to move into an older building with low ceilings and none of the amenities that these new apartment buildings have been designed with, and views and so forth? These buildings were designed as office buildings. So you're not going to be able to be bailed out by conversions. At least can stretch 10 years before they are due to renew. It may take years for the office space market to clear. That's the problem. That's why commercial real estate, especially office, lags the economy usually about 18 months because it's reactionary, and then you've got all these leases. So right now, really in 2024, 2025, 26, 7, and 8, we're starting to feel the pinch. Think about it. If someone signed a 10-year lease in 2018, they had no idea what was going to be happening. They had no idea that there was a pandemic coming. They had no idea that there was going to be assassination attempts and resignations, and none of this stuff was in the pipeline. I don't care how much they pay for consultants and doing forecasts. Nobody predicted these things. The work from home, the interest rates spiking, inflation taking off. Nobody was predicting these things, right? 2018, how about 2019? Well, 7-year leases and 10-year leases signed then, which a lot of corporate users, large, if you have over 5 or 10,000 feet, you most likely signed a 7 or 10-year lease in 2018, 2019, 2017, 2020, even early 20. Folks signed these leases. So we haven't dealt with that yet. We're still waiting for those leases to expire and work its way through the system. And that's what's coming. So here they say hardening companies for CRE storms. Corporations should prepare for an extended period of tightening standards, tightening lending standards, elevating borrowing costs, and possible market liquidity shortages as banks work to resolve the CRE challenges. Okay, so expect there to be a hardening of the lending practices from banks as they try to survive. Importantly, corporate managers should know of any provisions allowing their financial institution to transfer depositors' assets to third parties for management. In such cases, executives should be aware of safeguards for their banks have in place should third-party asset managers become duress. Finally, companies should monitor liquidity exposures of key counterparties, including subsidiaries, suppliers, customers with credit lines, creditors, and debtors. While expensive, such measures may mean the difference between survival and extinction when the commercial real estate reckoning comes. Now, again, she's saying this, or this person saying this, as Kurt, the author here, is saying this as a matter of fact, that there is a day of reckoning that is coming, as a matter of fact. So where is that? Is that here? Okay, that's here. Just give me a quick technical difficulties. All right, well, we'll try to make that as convenient as possible for you. Okay, so U.S. real estate is heading towards, commercial real estate is heading towards a financial crisis, and that's where we are, folks. So hope we were able to help you there looking at that. Now I made it worse. All right, let's go to the next one. Deutsche Bank, kind of very similar. This is not helping me out here. Why is it doing that? Give me a quick second. Interesting. Okay. Deutsche Bank, another large group that warns, and here's the title, commercial real estate remains under pressure. Yeah, you think? All right, we won't get too far into this. This focuses on Europe real estate and euros, but the chief financial officer, James Van Moltke, told journalists that conditions were improving, but more slowly than he anticipated, and provisions for commercial real estate in the U.S. will continue to be impacted. So here he is speaking from Euro, talking about the recovery I might have expected a couple months ago hasn't happened yet. Commercial real estate continues under pressure for the remaining half of the year. They've had two torrid years as higher interest rates jacked up borrowing costs, pandemic hammered demand for offices, sending valuations tumbling. All right, so we'll keep going there. That's Deutsche Bank. Here's another article. Let's see here. Now, who's here? This is from Wall Street Journal. Real estate meltdown strains even the safest office bonds. So you could see everyone is talking about this. Commercial real estate meltdown is spilling over into the bond market. Defaults are mounting in favorite Wall Street mortgage bond investment, setting off fresh alarms about the future of offices and malls in cities across the U.S. So look, the whole world's looking at the U.S. saying, oh dear, what's happening over there? About $260 billion of deals known as single asset, single borrower bonds held by investors such as banks, insurers, pensions, and mutual funds. Landlords, often private equity firms, use that money to purchase skyscrapers, shopping centers, and other properties. Much of the debt is coming due, and refinancing markets are frozen for many office and retail landlords, some defaulting even before their due dates because the interest expenses soared when the Federal Reserve raised their rates. So we didn't really talk about when you start, hey, I did it, it disappeared, the little line there. I hope that's better for you. Okay, so you've got tenants with demanding less amount of office, so you have lowering of occupancy, which relates to less income coming into the office building. At the same time, you have increases in property insurance, electricity, labor costs. So less income, higher expenses. Now, what else do you layer that? These interest on the loans. These loans are 5-7 year balloon payments, sometimes 3-year balloon payments, and you have to refinance. They're interest only. Now they're going back after buying at a real estate 3 to 5 years ago when interest rates were 2-3%, and now it's 8%, 7.5%. And so the cost of capital to hold on to that real estate is also higher. Combined with the less valuable real estate, now you have to put more equity in because of the LTV. It's a perfect storm for real estate folks, and particularly in the office sector, and that's really impacting even the bond market. The losses are particularly jarring for investors because credit rating firms initially gave many of the bonds AAA ratings higher than even the U.S. Treasury bonds. The financial models behind the ratings never forecast property prices falling below the value of the debt. That's what I'm trying to highlight, that what happens when the loan-to-value ratios flip. Now you've got the loan is worth more than the value of the building. That's a problem, and that triggers a default, and that triggers an action by the landlord. Either they come up with more equity, or they give the keys back to the bank, or they play this pretend game. And so that's what's happening here. When the pandemic gutted demand for office, private equity firms abandoned near vacant buildings and their debts, leaving bondholders holding the bag. Owners of a bond backed by Blackstone-owned buildings took a loss after the property was sold in April, the first such impairment ever, according to research by Barclays. The market is headed for more turbulence as more AAA bonds get hit. Imagine you bought a AAA bond, safest investment, even safer than the U.S. Treasury yield, and now you're selling at a loss. There are at least 10 other deals like this likely to take losses, said managing director from Deutsche Bank. All right, so there you go. Blackstone's been in the news a lot lately, haven't they? All right, let's keep going. Here's another one from Blackstone, and this is Mr. Blackstone here. This is Blackstone still sees substantial pressure in the office sector as real estate market recovers. This is from Market Watch. So everyone's talking about this commercial real estate crisis. Blackstone more than doubled its real estate investment activity to $10 billion in the second quarter as a private equity firm continues to see bottoming out of broader commercial real estate sector. While some pockets of weakness may persist in the distressed office space sector, Green Street Commercial Property Price Index has turned in 6 months in a row of flat or increasing values, Blackstone said on an earnings call. A lot to talk about here, but even Blackstone is saying that they are feeling the pinch and paying attention to commercial real estate and the pressure. Let's see here. Among its most recent deals, Blackstone took Apartment Income REIT Corp. private in June in a deal valued at $10 billion that followed $3.5 billion move to take Canadian multifamily. Blackstone stock is up 6.5% in 2024 compared to 15.7% by the S&P. Blackstone Mortgage Trust shares has fallen to 8% so far this year. All right, so Blackstone in trouble. All right, criticized bank CRE loan rates showing risks of rising. This is from Globe Street, and we will not read this just for time's sake, but we're going to keep moving on. And then we'll end with this one. This is from Connect CRE, and it says CREFC Sentiment Index reflects growing caution over economic outlook. What I like about this is I got a lot of charts. As someone says, words speak, numbers scream. That's a quote from Tom, I think, over at the PVD podcast. So shouts out to you, Tom. All right, CRE Finance Council, CREFC, said its second quarter 2024 Board of Governors Sentiment Index survey decreased to 102.4, 3% decline from the previous quarter at 105.4. Now, why does that matter? Let's see. Drilling down into the survey's core questions, it reveals significant changes in expectations and insights. They include the following. Industry sentiment has moderated with 61% neutral, 22% positive economic outlook. Confidence in the U.S. economy has waned. Okay, that's where we're getting. Bottom line with this, only 11% of respondents expect better performance over the next 12 months, down from 24%. Federal policy impact, natural sentiment toward federal legislation and regulatory actions increased 67%. Negative sentiment decreased 26%. 41% of respondents view the impact of rates positively, up from 31% in Q1. That's mortgage and cap rates. CRE fundamentals, stability is expected. 24% anticipate improvement, consistent with the previous quarter, so that stayed stable. Transaction activity, demand is expected to remain strong. 54% expected increase in investor demand, consistent with the prior quarter. Financing demand, expectations for borrowers' demand is slightly decreased. Liquidity, expectations for improved liquidity fell to 46%. CMBS market, positive sentiment, demand decreased in the CMBS market. The second quarter 2024 survey reflects an industry forging its way through significant uncertainty, said Lisa Pendergast, executive director at CRE FC. As the industry navigates these challenging waters, its resilience and ability to innovate will be key to capitalizing on emerging opportunities while mitigating potential risks. So we can continue. Office loan delinquencies on the rise in 2024, and it goes city by city. Denver, Nashville, Chicago, and the Twin Cities experiencing, and Atlanta leading the charge in terms of office loan delinquencies. So listen, when we talk about commercial real estate in crisis, that is not hyperbole. That is the talk. And we could have kept rolling and rolling and rolling, article after article after article. All folks are looking to this. It just makes sense. You've got a situation of rising cost on every level, both interest rates, cost of capital, equity demands on the real estate, insurance, property holding cost, utilities, labor. It's just on and on and on and on. And that's why you can see where the commercial real estate industry last week freaked out, when you've got this tremendous pressure, and that's not even overlaying on top of that the federal government say, oh, by the way, we're going to cap your ability to earn a profit and raise rates. What? I mean, you talk about a crash. If that were to happen, you're probably talking about the greatest crash in commercial real estate that we've ever seen, as a lot of folks would say, okay, fine, here's the keys. Go for it. You do it better. But that's where we are, CRE crisis. Hopefully this doesn't become, we did these office sector woes. I was considering calling this office sector woes part 7 or part 8. But this is not just about the office sector anymore. This is about the entire commercial real estate industry in crisis mode, and people are starting to report on this and paying attention to it. So we'll do our best to track this for you and pay attention to it. And we appreciate, as always, your time. Remember, Proverbs 20:18, plans are established by counsel, by wise counsel wage war. Again, if you haven't connected with us, please do. It's Commercial Real Estate Talk. You can find us wherever there's podcasts. If you're listening to this podcast, there is also a video of the same podcast, so you can see these charts and articles that we talk about. And please consider giving us a thumbs up and subscribing if you haven't already to Commercial Real Estate Talk podcast, so we can continue creating good content. And if you need any commercial real estate help in South Florida or anywhere in Florida, we were just in Tampa recently, in Orlando, all the way up to Port St. Lucie, anywhere, say south of Tampa, we're happy to help you. Please find us at blueboxre.com. I've got my bio there, and you'll learn all about what we do in commercial real estate. Thanks for tuning in. God bless you and your family, and look forward to talking to you again in the future. Good day. All right.